Okay, let's dive back in. Let's take a deeper look at what we mean by equity capital and what we mean by debt capital and how both of these things work. Okay, so all about equity capital. So entities raise equity capital when they sell shares of stock, and they do this in a primary market, right? And the key features of these shares of stock or equity are as follows. So each share of stock, like I said before, is an ownership interest in the company. So let's see how this works. So for example, if we have Smallco has issued 100 shares of stock total. So we would say in that case, it has 100 shares of stock outstanding. In this case, if you own one share, you own 1% of Smallco. If you own 100 shares, you own 100% of the firm. Okay, remember, shares of stock, ownership certificates are not contracts. So what are the implications of this? You have no promise or guarantee of anything with a share of stock. Price appreciation, dividends, whatever. Companies can change their dividends at any time. They don't need permission of the shareholders. Okay, so why would you purchase? Why would you want to do this? People do this because they're buying the ownership stakes in the expectation that the valuation of the company will increase, and or because they are hoping that the company will continue issuing dividends or start issuing dividends to the owners of the firm. And the bad news is if the company goes bankrupt, the stockholders get compensated last, okay? And usually when a company is bankrupt, its liabilities are much greater than its asset. So the way it works is the company will sell off all its assets and it will pay as many liabilities as it can, starting with who? Starting with the contract holders, the debt holders, okay? And they don't get everything they're owed because the company has gone bankrupt and can't pay them everything they're owed. And that means there is typically nothing left over for owners to get if a company goes bankrupt. That's why debt is less risky on the downside. Of course, it has a capped contractual upside, which ownership stakes do not have. Okay, quick important note on the lecture handouts. You will see sometimes that there is information provided in gray instead of black. Anything that you see in gray is optional. I've put it in there for the small but important and wonderful minority of you that are interested in digging a little deeper, learning a little bit more. But you're not going to be tested on anything in the handouts that is in gray. Okay, so now let's think about some key features of equity markets now that we've dove a little deeper into equity. So we're skipping the gray, and the secondary market transactions, as I pointed out briefly before, typically have nothing to do with the issuing of the issuing entities. So for example, with Apple, millions of shares of Apple are traded a day, and Apple, the company itself, probably hasn't had anything to do with that, probably didn't buy or sell any shares that day. So it has nothing to do with the price of those shares going up or down. It doesn't directly benefit or get in trouble by the price going up or the price of the shares going down. Now, that said, can secondary market transactions benefit or harm entities? So I just said not directly, but indirectly, they definitely can. So let's think about that. Yes, okay. So let's say the price goes, let's say price per share, just make it. Okay, if the price per share goes up, this is going to imply for Apple or whoever's price per share is going up, that when they issue more stock, so let's say they want money to launch, good God, they've launched so many great things, the iPhone, the iPad, the Mac, etc. So they've come up with the latest, greatest thing. Maybe it's going to be their augmented reality glasses, and they need a couple billion to do that. So they could choose to issue shares to do that. And if the stock price is really high, let's say $1,000 a share, let's say they need $10,000 just to keep the math simple because I have such little bandwidth, I can't do serious math in my head. So let's say they want to raise $10,000. If the share price is $1,000 a share, they only have to issue 10 shares. If it's $100 a share, they have to issue 100 shares, and that dilutes the ownership more of the existing shareholders. So that's a good thing. And on the other hand, if the price per share goes down, the opposite. Okay, and let's think a little bit about bonds. Okay, so okay, so similar sorts of things happen with the bonds. If the price of Apple's bonds go up and they want to issue new bonds, the price going up means that the marketplace thinks the company is really great. So it'll be very easy for them to issue new bonds and get a low interest rate on those new bonds. Similarly, if the price of an entity's bonds tank, let's say they're issued at $1,000 a bond, they go down in the secondary marketplace to $500 a bond. That's the marketplace saying that this company is very dangerous, may go bankrupt. So if they go to issue more bonds, they're going to have trouble. And if they can issue more bonds, it's going to be at a very high interest rate. So secondary market transactions don't directly have any effect on the company, but indirectly, they can have a great beneficial or deleterious effect. Okay, as we know, issuing entities can repurchase their stocks in the secondary market. And as Warren Buffett says, accounting is the language of finance. So I need to remind you of how we would record buying back shares if we were an entity in the secondary marketplace. Okay, the journal entries would look something like this. Cash would go out the door, so that would be credit cash. Okay, and we would say debit paid in capital. When we issue shares, it's credit paid in capital for the dollar amount of the shares issued, and it's debit cash for that same dollar amount. So when you buy back your shares, it's exactly the opposite of that. Okay, so where do ownership shares get traded? There are several marketplaces for this. I've got some examples shown for you here. So the first one is what's called OTC Link. This is sanctioned by the American Securities and Exchange Commission. It's not really run by anyone. It's just a wild and crazy place. And there are no listing requirements. So all of us could get together and create a company, and we could list our shares on OTC Link. We don't have to be a certain size, we don't have to be profitable, et cetera, et cetera, et cetera. Okay. A better known exchange, which is for better established companies, is the Nasdaq. This is also sanctioned by the SEC. It's run by the Nasdaq itself, and it does have listing requirements, minimum market value of equity, and you've got to report, you've got to provide financial statements and other reports quarterly to the Securities and Exchange Commission. And similarly, here's another stock exchange, the New York Stock Exchange, also sanctioned by the SEC, run by the NYSE Stock Exchange, and it also has listing requirements on minimum market value of equity and quarterly reporting to the SEC. So if you are an entity, you do not need to list your shares on an exchange. There's no law that says you have to do that. And let's say you start a company called Smallco. You may sell ownership certificates, shares of stock, directly to friends and venture capitalists. You don't need to have an exchange to do that. If you're selling shares that are not listed on an exchange, in that case, we say that your equity, your ownership certificates are privately held. And let's say you get big and awesome and great, and you want to be listed on an exchange, which has a lot of advantages, including transparency. It's actually good to have the equity market making a record of what they think you're worth. It makes your firm much more transparent, et cetera, et cetera. So you want to be listed on an exchange. The first time that you listed some of your shares for trading, take some of your shares and you make them available for purchase and sale by anyone on the Nasdaq, for example, that's called an initial public offering. So that's the first time a company issues shares on an exchange. And similarly, you can issue more shares later on an exchange, and that's called a secondary offering. This is still done in the primary market. Remember, primary market is where you sell shares on the exchange. Secondary market is where everybody, mere mortals, buy and sell those shares amongst themselves. Okay, so now let's do a similar deep dive into debt capital. Okay, entities raise debt capital in two primary ways. They take out loans, okay, or they sell bonds. And both of these are, of course, primary market transactions. Key aspects of debt. Debt, unlike equity, debt is always a contract, okay? We saw how that worked in the first chapter. An entity receives an amount of cash now in return for repaying in full later and paying interest along the way, okay? And most debt contracts are structured such that if the company cannot make a future payment, that would be called a default. At that point, if they miss an interest payment, not necessarily a repayment of what's called principal, the original amount borrowed, if it just misses an interest payment or even part of an interest payment, the contract is written so that the lender essentially has the right to take over the company. So it's very similar to, you could think of defaulting on a mortgage. So what happens in that case if a company knows it's going to default on a loan or a bond payment? It typically runs to a judge and says, help me, I need to file Chapter 11 bankruptcy protection because I can't make this interest payment, and the evil me and JP Morgan Chase Bank is going to take over my company if you don't help me. So that's what Chapter 11 bankruptcy is about. If the judge accepts that, they say, hold off for a second, JP Morgan Chase or whoever the lender is, you can't take over the company yet. We're going to work this out in a bankruptcy proceeding. So it really is just postponing the inevitable, but it's very common for companies to run into Chapter 11 bankruptcy protection when they cannot meet their contractual obligations for debt. Okay, so if a borrower does file for bankruptcy protection, one thing the judge is going to do is figure out who gets repaid and how much. And the judge is going to decide that. You, the entity, are not going to decide that. And almost always what happens is the owners, the shareholders, get nothing, and the debt holders don't get as much as they're contractually owed. Okay, so as we've seen before, there's these two main types of debts. Okay, so loans are a contract made directly between an entity and one or more lenders, and bonds are, these are not marketable securities. They're just contracts, but they're not broken up into individual securities like bonds. Bonds are, of course, marketable securities, and each bond, as we learned in Chapter 1, is a transferable contract. So the borrower is promising to pay whoever is holding the bond at certain times, certain amounts of cash. So whoever is holding the bond after a year, say, gets the interest payment for that year, and whoever is holding the bond at the end of the contract gets the final interest payment and the principal amount of repayment. And remember that the price of the bond in the secondary marketplace has nothing to do with the cash flows that the entity has to pay. Entity has to pay the cash flows that are established initially in the contract, and what happens when the bond is traded in the secondary marketplace, the price of that bond has nothing to do with that. Okay, so some example bond trading platforms. For example, BondDesk is a very popular one. It's run by a company called Tradeweb. It's designed largely for retail investors, and it's called an electronic exchange network, or ECN for short. Nasdaq is an ECN. An ECN is just an exchange for stocks or bonds that has really no human intervention at all. It's all run by computers. The New York Stock Exchange does have some face-to-face interaction, so that is not considered an ECN. Another very popular bond marketplace is BondPoint. It's run by a company called Knight, also for retail investors. It's also an ECN. Another one called Tradeweb is largely for institutional investors, and Market Access, run by a company with the same name, also largely for institutional investors. Okay, key features of bond markets. Okay, as I've hammered in hopefully to you enough, right? Entities only raise capital when issuing bonds in primary market transactions, okay? And or getting loans, of course, okay? And as far as bonds go, other marketplace trades have nothing to do with the issuing entities unless that issuer is repurchasing. And now let's go back to financial accounting. How would we record this? You've got to remember your financial accounting. So let's say an entity decides to repurchase some of their bonds in the secondary market. The journal entries for that would be CR cash, credit cash, because cash is flying out the door to buy those bonds back. And then we would debit our bond debt. That's the bond debt that was credited when we issued the bonds. Okay, this whole page is gray. I'm not going to bother you with that. And I think, again, this is another good place to stop. And after this break, in the next segment, we'll look into derivative securities and shorting. So let's take a pause here, and I'll be back with you soon.